Aaron Cox with IULaccount.com. We're going to talk about what is an IUL account? What is an IUL policy? You've probably heard that term going around at work, maybe friends, family, somebody's brought it up, your boss has said, hey, you should look into an IUL, and you're like, yeah, of course. What is that? So we're going to get right into it. You're probably familiar with universal life policy, right? Some of the biggest people in business had universal life policies. Ray Kroc, founder of McDonald's, J.C. Penney, James Cash Penney, Walt Disney. Walt Disney used his universal life policy to help him fund his whole Disney theme parks because he couldn't get the loans from the bank, from what I understand. So the Rockefellers, I had to think of the Rockefellers, I had to mention them. So universal life policies have been around for a long time. There's a IUL. It stands for Indexed Universal Life. So the index part means that it's mirroring a stock market. So the difference is with the typical universal life policy in the past, it was just a declared interest rate that the company decided they were going to give. But with the indexing component, now there's transparency in terms of how this account grows, right? So the way they work is basically, let's say ours is, we're using the S&P 500, right? So when that grows interest, our account goes up. We're earning interest with the IUL, right? When the S&P goes down, what should happen? Well, normally when you're invested directly in the market, that account decreases as well, and that's what's happening with a lot of people in their 401k. They're waking up and they're finding that they're losing some money in it because it's directly invested in the market, right? So an IUL you're not directly invested in the market. You're putting your money, contributing to an insurance company, right? Who then is out and hiring the best investment portfolio managers that their money can buy, and they're producing profits, right? And you get to participate in that profit, but you have the protection against losses in the market. So when the market goes down, that stock market goes down, your money just plateaus. You're not gaining money, but more importantly, you're not losing money. You don't have to recover, right? Okay, so that is probably the main magic bullet of the IUL, is that you're locking in all the gains without suffering any of the losses, okay? So that's like, again, that's like one of the most exciting things. Imagine if you could invest in the stock market and never lose, right? That's what you're essentially doing, okay? Now, in return for this, oftentimes the insurance company will put like a cap on certain crediting allocations. So they'll have a few choices, and let's say if you choose the S&P 500, there's a cap on the gains. Maybe that cap is 10%, let's just say. So what that means is if the S&P 500 were to go up 13%, then and you're capped at 10%, there's a 3% difference. And that little spread, that's what the insurance company, that's part of the money they get to keep. They get to keep that spread, and that's part of the money they use, so they're able to protect you when the market goes down, right? Okay, so that's how that works. Now, year after year, you're accumulating this interest. This interest is compounding, right? And the earlier in life we begin, the more time it has to compound, right? The more money you put in, the bigger the seed. Again, if 10%, if you're earning 10% of $1 million versus 10% of $10,000, well, which account's earning more? Obviously, the bigger seed. $1 million, that 10% is 100,000 versus 10% of 10,000. So the more money you put in, and the earlier in life you start a policy, the more the wonders and magic of compound interest work for you. Okay, so that's basically what your account is, and people design these policies. They design them to. A lot of times they're geared towards long-term savings. I mean, that's what you're doing it for. You're doing it for long-term savings. So They're designing them as a retirement, part of their retirement portfolio, but you can use them, you can use them, I don't know, to put down payment on a house, to start a business, to buy a car. You can use it for whatever. That's the beauty. When you go to take money out of an IUL, no one's going to ask you, hey, it's not like going to a bank where a bank's going to ask you, okay, let's see, how are you going to pay this back? Do you have a job? What's your credit score? No one cares what you're spending the money on. The IUL, you're allowed to borrow from that cash value that is accumulated, right? And no one's going to ask you your credit score. No one's going to ask you what are you going to spend the money on. No one's going to ask you how you're going to pay it back, right? That's not how IULs work. Okay. At the end of the day, the insurance policy is the collateral on the IUL. So you don't technically have to pay back if you take loans out of your IUL account. Then at the end of the day, let's say you were to pass in 20 years without repaying that loan, then it would just be deducted from the death benefit that goes to your family. All right, so that's how that loan would end up being reimbursed to the insurance company. So you don't technically have to pay back. It's always good to pay back stuff. You're essentially paying yourself back. So that's kind of why that's a big part of the reason why people call these becoming your own bank. You've probably heard of that strategy or the infinite banking concept. People can use IULs to achieve that as well. So that's the idea. Yeah, you contribute to one of these accounts. Many years down the line, oftentimes people will stop their contributions, and then they will start to take yearly salaries, essentially a yearly salary, and they'll pay themselves year after year, and that's a way that they fund their retirement. Okay, but again, you don't have to wait till you're 59 and a half. You don't have to wait till legal retirement age to start accessing your money, unlike your IRAs, your 401ks, those qualified retirement plans. So there's a lot of advantages. I'd say if I was to sum it up into four different things, I would say, number one, you have the high upside potential when the market is good. You have the downside. Number two, the downside protection when the market isn't so good. And then you have a guaranteed death benefit. You have a guaranteed death benefit for your family, your beneficiaries, to pass on generational wealth. And then lastly, when you pass that generational wealth on, it's tax-free, right? So your money grows tax-free. When you need to borrow it, when you need to take a loan out of your cash value, you can do that tax-free. And when you leave it to your beneficiaries, it's tax-free. So, I don't know if there's a better product on the market for long-term savings. There's other things you could do, flipping real estate. You could do these types of things, ventures, and potentially make more in interest, higher ROI. But the cost barrier of entry, the risk, that's involved in some of these other things. If I'm going to go buy a house and start flipping it, I'm probably going to have to put down at least $10,000 to buy a house, even in the most. Yeah, I would probably. You're going to have to come up with usually a pretty considerable down payment, and then the risk. You're going to put money into building this, and then hope that you can sell it and flip it on the market. There's a lot of things that happen in between there with that kind of strategy, where sure, ROI could be higher, but the risk is a whole lot higher. So in terms of the safety, security of an IUL account versus most other things, the liquidity, again, like I said, your money's liquid. If you need to take a loan out, after the first year, in the first year you can't take a loan out. But after the first year, if you need to take some money out of your cash value accumulated, you just let the insurance company know. And yeah, I mean, yeah, that's yeah, the liquidity, the security, the flexibility of premiums. If money's tight a certain month, let's say your policy is $500 a month, right? But all of a sudden money's tight, right? My car broke down and I gotta put money into that. So you could change your next premium payment to the monthly minimum, which might be, $85, $90, $100, somewhere in there. And so now you get a breather this particular month. So yeah, the flexibility. Yeah, I just, for me, I'm going to look at an IUL all day, every day. It's just not, it's one of the best products on the market. So guys, we'd love to talk with you more and answer your questions about IULs. So go ahead and contact us, get in touch with us. We're here to help you.